Good morning, traders. This is Brad Matheny. Today is the 18th of March. Boy, what an exciting week we had last week with the Fed stepping up to try to save the U.S. and potentially global banking system, and now Credit Suisse in trouble, to put it lightly. And I can only imagine that other global financial institutions are struggling, to put it lightly. And I believe this is going to lead to a wave of defaults over the next 24 to 36 months, which you are going to see in global corporations, particularly possibly involved in real estate firms, commercial mostly. I think that residential is going to kind of be similar to the mid to late 70s, early 80s, in a little bit of stagflation, whereas interest rates will stay relatively high. Commodities and consumer demand will stagnate. The excesses will wind down over the next 18 to 24 months, and possibly we will move into some sort of a growth phase in late 2024, early 2025. But the next 18 months are going to be very, very interesting. Now, I'm pointing to my webpage right now. I want you to please come check out my webpage and sign up for the 60-day trial of the Expert Growth membership. I will highlight that I may be adding a new investor-only service to my subscription services. The Expert Growth includes everything I do, but I'm getting a lot of people that are interested primarily in just investment strategies. And that's what we're going to look at a little bit today. Number one, I'm going to start pulling away from offering free research out on YouTube and Twitter. I'll still post some things out there for you like this video, but the idea here is for you to come support my research. I make this very inexpensive and very functional for you. If you are a trader and you are an investor and you have money in the markets or in real estate and really want to have a clue as to what's going on in the markets, then you want to come visit me. You want to come support me, where you will get all of my services, my cycle patterns, my custom indexes, everything that I do under the Expert Growth membership. And remember, the core of my strategy is the momentum reversal, the rotational modeling system, which you can see here has outperformed the SPY considerably. Beyond that, I provide a whole host of other content for you to be able to access and review. And the idea here is I do the research, I give you my interpretation, and then you make the decisions. So what we're going to be looking at today is, while I urge you to come check out my Expert Growth membership, get it on special right now. You can have a tremendous savings, or you can start the 60-day trial for $35 roughly, and that's a great savings for you to see what I do. Now, what we're going to do first is we're going to take a look at the rotational modeling system. Now, I know this might be kind of tiny on your page, but let me zoom it up. These were created for, I tell everyone I post every Sunday. In reality, I do all the work on Saturday and then post up all the videos on Sunday. So this is dated for tomorrow, but this is updated as of Friday, the Expert Growth membership. And you can see how it is performed compared to the SPY. Now, I want you to pay attention to this because this is really the core of all of my analysis. And I want you to see that the performance of the Expert Growth, the rotational modeling system has been tremendous over the last 25, 26 years. So this is the performance results of the system. You can see the red is highlighted for negative years. The green is highlighted for positive years in general upward trends. The MENT rotational modeling system performs just like the SPY. So here we had 31.44%. Here we had 31.44%. Where the MENT rotational modeling system actually outperforms the SPY is in containment of price volatility and being able to take advantage of downward cycle trends. So for example, in 2000, 2001, 2002, the SPY lost a little more than 20, 30, 46%, 47%, whereas the MENT rotational modeling system actually made money. Now, when you got this back here, this little 29% recovery or 26% recovery, remember that through the years 2000, 2001, 2002, the MENT rotational modeling system was actually increasing your returns. Instead of having a 46% decline, you were actually growing at a rate of about 20, 25%. So when this finally started to recover and the MENT rotational modeling system continued to perform, you were already outpacing the SPY by close to 40% at this point. Same thing happened back over here in 2008. So we had, you can see, we rolled into a year where the SPY actually outperformed the MENT rotational modeling system in 2006. Okay, we had a flat year in 2007. SPY was still outperforming. Then the rotational modeling system outperformed the SPY by close to 45%. Then it continued as the SPY recovered. The MENT rotational modeling system continued to perform until this 2011 year, which is a kind of an outlier. And then you can see we dropped back into bullish trending in 12, 13, 14, matching the SPY perfectly. 2015, we made a little money where the SPY lost money. 2016, they're almost on par. 2017, they're on par. 2018, the MENT rotational modeling system made money. SPY lost money. 2019, the MENT rotational modeling system made 19.4%. SPY made 28.79%. 2020, the SPY or the MRM made 24%. SPY lost 16%. 2021, they're on par. 2022, just last year, SPY lost 19.48%. MENT rotational modeling system lost 1.06%. This year, because of rotation, the MENT rotational modeling system right now is minus 3.2%, whereas the SPY is up 1.89%. That's again from the base bottom that occurred last year. But pay attention to these numbers. So the comparative strategy volatility ratio shows the SPY has an annual standard deviation range based on these numbers of 17.58%. So that's your 1x standard deviation. Understand that that means that throughout any year, you're likely to see somewhere between a 17 to possibly 25%, maybe 1.5 times type volatility. Whereas the MENT rotational modeling system has an 11.31 annual comparative standard volatility. And the average standard volatility between them is 13.93 versus 9.02. The difference is that the MRM strategy, the MENT rotational modeling strategy, knocks down close to 35, little over 35% of the type of volatility that you see in the markets and is more consistent overall. So again, when we take a look at this from a standpoint of performance, what you need to see is that the SPY standard volatility is 17.85, meaning that you're going to be roughly 17.5 to 23, 24.5 in typical price volatility, whereas the MENT rotational modeling system averages an annual standard deviation range of 11.31. Again, this is about a 40% decrease in standard volatility. You're going to be safer running the MENT rotational modeling system compared to large drawdowns than you would just be trying to trade the SPY. On an average, the range again is considerable. You're talking 14% up here versus 9% here. Okay, this is really almost a 40-some% decrease. It's actually 35.26, but I'm rounding it, so let's just call it 35. The savings here is incredible, and the performance is incredible. What happens here is the MENT rotational modeling system is more capable of allocating capital more efficiently to price trends than a simple buy and hold strategy which most investors perform in their retirement accounts. And this is the strength of what really my services provide you, is the better way to manage and grow your capital going forward. Now, if we go back to the setup here, we are currently in a bullish weekly setup at 25% allocation, a bearish daily setup at 75% allocation. That nets into a combined one account position of 50% bearish, 50% cash. We're currently up 1.61% in that position. This is the way it works. It's very simple. If you have two accounts, which is the way I run it, you allocate the money effectively based on these top two windows. If you have one account, you're going to roll between net bullish and net bearish positions, periodically having money stashed away in cash. Now, this would be your primary investment or retirement or 401k account. This is how you would execute it. You just basically follow these triggers. These triggers come typically 2 to 4 times a year. Okay, that's pretty much where we're at. The last trigger was at 2/24/23, and the last trigger long was at 6/10/2020. So this weekly system is really only going to generate maybe 1 or 2 trades a year. This daily system could generate anywhere from 2 to maybe 5 or 6 trades a year. So again, very simple, very easy to follow, and the benefits are extremely clear. Oops, the real estate. And then this is the updated market trends. Now, like I said, I'm going to show you something in this video that may end up becoming a new service specifically for investors. But it's interesting as we move through this data to see what's actually going on in the markets and to understand what's going to happen. Remember, a lot of people believe the markets are going to crash, that there's going to be some sort of a broad financial crisis. I don't believe that's going to happen. I believe that the Fed is going to do whatever it takes to try to prevent any type of a banking crisis, potentially turning on the printer and moving back into lower interest rates. That would be an extreme case outcome. The reality of the outcome that I think is going to happen is that we are going to settle into a moderate uptrend. Remember, we have about 16, 18 months before the 2024 elections, and I believe they're going to pull they're not going to hold back, let's put it this way, in trying to keep the systems running through the election. So I think the Fed is fully capable of doing whatever is necessary at this point to offset minor risk contagion. If we end up with some sort of a major risk contagion, then we'll play that as it comes. But I think right now we're dealing with minor crisis events. Credit Suisse is another story altogether. Credit Suisse could have, potentially, $50 trillion in underlying derivative risk, and that could be a real problem for the global financial market, particularly the Swiss and the European economies and anybody tied with Credit Suisse. But the unwinding of something like that in a crisis mode would still be fairly isolated compared to a broad U.S. banking crisis like we had in 2008, 2009. So again, the daily and weekly performance here is showing you daily trend versus weekly trend. You can see here, SPY is bearish daily, TRAN is bearish daily, MC is bearish daily, ES is bearish daily. All of these are bearish except for gold and silver, which moved positive last week. Gold has moved positive into a weekly bullish trend. The SPY, TRAN, midcap, and ES are all still bullish weekly. Same thing with consumer staples and U.S. financials. Believe it or not, U.S. financials have not crashed into a weekly bearish trend. Daily, they are bearish. That means that short term, we're in a bit of a downtrend. Weekly, we're still bullish. Current allocation for your trading account has not changed. There's a reason why I keep this 25% metals hedge, and if you followed my research enough, you know that I believe we're entering into a 2003 to 2006 type of market trend, which is really, if you were to blend it, kind of a 2003 to 2006 market trend, if you remember it, and possibly a late 70s to early 80s type of stagflation type trend. And I think if you were to blend those together about 50-50, that's what we're going to have over the next 2.5, 3 years until we see some real growth. Okay, so we need to stay properly hedged. Metals are a very efficient hedge, better than bonds right now. This would be the allocation for your trading account. Think of it as 2 separate accounts. If you have money in the markets, you would have 90% of it in your investment account and possibly 10% of it in your trading account. Trading is your speculative account for essentially trading as you wish, picking stocks, picking ETFs, picking whatever, and trying to speculate to actively trade different stocks that you like, whereas 90% of your money is in your retirement account. Your retirement account is this. This is what you follow for your retirement account, or this. This is the same setup, the MENT rotational modeling system. This is your daily and weekly trend bias for different sectors, as well as your allocation for your trading account. The purpose behind this is that for your trading, you want to remember that you want to try to take advantage of opportunities when they're there and move money away from risks when when the opportunity is not there. And that is the purpose of this, by showing you how I would suggest allocating your capital. This gives you a guide point to understand when there's real opportunity in the market and when there's not, how to hedge effectively, how to move capital away from risk by going to cash, and how to allocate into your stock. So if this were hypothetically a $100,000 account, you would have $25,000 available for trading, broken into maybe 10 or 15 trading slots. That would break it down to about $2,000 or $2,500 per trade, maximum per trade risk. If you were to risk, say, 5 or 6%, that means that you're really only risking theoretically 0.5% or 0.4%, depending on how you break up your trading account. You would have 50% of your money in cash and 25% of your money in metals. Now, why metals? Obviously, metals are a hedge against risk. And I believe metals are going to be continuing to go straight up over the next 5-6 years. So pay attention as to why you want to hold metals as an effective hedge. And particularly, you want to hold physical if you can. And you can still invest in GLD or others, but wait for the actual triggers to generate trends in these hedges. Alternately, if you can't hold metals, so you don't feel comfortable holding the ETFs, you would be 25% stock, 75% cash. And of course, cash is king. In my opinion, metals are queen, let's call them. You really do want to try to get your hands on some physical metals. That's how I do it. Okay, now let's take a look at some of these trends. What we're going to do over here is we are going to come to, this is the TT charger system. And what I want to show you is from a long-term standpoint, the ES, and what I'm going to do here is I am going to, well, I will leave it so you can see, but what we're looking for here, ladies and gentlemen, are these little diamonds. Let me move it over here so you can see. See these little diamonds here? This tells us the general trend. So we have been bearish since way back over here. This is a long-term modeling system. We are still bearish on the weekly chart on the ES, the S&P E-mini futures. This is still bearish, but I want you to understand there's some very interesting setups here. Now, these represent what is called market breadth, this red and this green. Market breadth indicates the normal range for price activity based on momentum. And when you start to see these types of moves here where there's breadth behind it, that means that it's got some real momentum to the downside. When the breadth starts to indicate below here, this means that it's waning in strength. So where we're at right now over here, we're essentially waning in bearish strength right now. And again, we were waning in bullish strength over here. Now let's take a look at the NQ. The NQ is bullish. NQ is bullish. Right down here are the little blue diamonds that tell us we are bullish. We do not have a breakout trend yet. We do have the auto trend master moving into bullish trending. So guess what? We are getting very strong signs of a bullish trend based on the TT charger system. The TT charger system is, again, a kind of a rotational modeling system. This is very good indication that we've had a capitulation bottom, that we're moving into some sort of a moderate uptrend like I've been stating. And I need you to prepare for what is coming. That's the purpose of this video, is to highlight what's actually coming. Let's take a look at the SPY. SPY is bullish as well. See the little blue diamonds? That tells us that we are now in an uptrend. Okay, and we looks like we got in around February 6th into an uptrend on the TT Charger system. Again, very strong confirmation of a capitulation bottom back over here, especially with this banking low. We stay above these levels. We should continue to see upward trending. I think March and April could be fairly strong, rolling into a period of weakness into May, June, and July, but it looks very, very impressive. Take a look at the transportation index. Bullish. Nice big bar here. Good solid trending right here. This is a good solid light green color, which is an indication of real potential momentum here. Then we get into waning back over here. We're looking for the market to roll back upward, try to get above this. This is IYT, 248 roughly, 250. Would be in the next wave to the upside, but transportation index on a weekly basis is bullish. Let's take a look at the IYM. The Russell, bullish as well, dancing very close to a protective level. We'll see how this holds up. Showing a lot of weakness here. Large caps are going to probably perform a lot better than the Russell here, but we could see a very strong rebound here over the next couple of weeks. I think we looked at the financial sector. Financial sector XLF is bullish from November 28th. We've been holding into this bullish trend here. You can see right here, bullish, bullish, bullish. We've got some momentum to the downside here with some waning showing up at the same time. We would like to see this hold and reverse back to the upside. We'll see what happens next week. These could reverse back into a downtrend if we get more downward trending, but understand this is a pretty good setup for a bottoming setting up in the market, and that's kind of what I believe is actually happening. Let's come back over here and take a look at gold. Gold is bullish from January 2nd, 2023, very strong momentum. You can see the bright green back here. This is showing good, strong momentum building, very little waning. Looks like this could continue quite a bit higher. My target for real gold is 2,200 roughly before it stalls out. I believe could get a little higher, but it's going to stall out after it reaches about 2250. Settle into a kind of a sideways trend, I expect, for at least a couple of months before we get into the next wave higher, unless there's some crisis event going forward. Silver, based on the rotational monitor, the TT Charger, is bullish from November 9th. Silver's holding up quite well. We've got a little bit of bearish momentum right over here, but I think that weekly, silver's going to move away from this as we continue to see it skyrocket a bit higher. I believe the next target really is going to be like for spot. I think it's going to be 31 to 35 up in this area, and then it's going to be fairly strongly bullish as it continues onward. Next, let's take a look at TLT. TLT is bearish. Again, we don't have any real opportunity in bonds yet. Bonds will likely struggle. They will eventually move into an upward trend, in my opinion, maybe closer to the end of this year, but we're not having any real opportunity yet for an upward trend. Yes, we saw a nice little bounce here, okay, but we have been stagnating now for almost 9 months in a very tight range, and I think bonds could be something that settle out maybe in October, maybe November, and start to move into an uptrend. Let's go to IYR. The real estate sector is just flipped back into bearish right here. So we were bullish temporarily, flipped back into bearish. As you know, I think real estate's going to continue to suffer. I think REITs are going to continue to suffer, and I think commercial real estate's going to really stagnate. I think it's going to get harder and harder for commercial properties to find suitable tenants in a stagnating economy, given what we have going into the next 18 months with a presidential election. Let's go XRT. Retail is now bullish, currently bullish, bouncing down off of these lows, looking like we may set up a bit of a bottom here. These could be extended bases setting up. You see how we've got this nice rolling bottom, kind of you could see the left shoulder here, the head, and then the right shoulder here. We may get a bounce back near this left shoulder area back over here, seeing it start to move upward. But this could be a slog of an upward trend over the next 6, 8, 10 months before we get some real momentum. Maybe around Christmas, maybe into middle of 2024. Let's take a look at real estate over here, XLRE. Bullish again. Looks like the stop levels moved right up into here. So we're kind of holding around this area. We need to see it move higher. I don't think it will, personally. We've got a lot of momentum. These red areas show a lot of momentum, potentially the downside. I think real estate could continue to suffer if the Fed keeps rates fairly high. XLP, the consumer staple index, is still bearish on staples. You can see we've rolled into this sideways trend. Staples may continue to stagnate out here. We've got a very solid bottom over here. Staples are something that, typically will move when consumers have the opportunity to really become, let's call it, looser with their money. In a downward trend, staples tend to go sideways flat. In an upward trend, staples tend to increase. So again, as the economy really kind of bases and finds a base for upward momentum, we could see staples roll around in a fairly tight range. You can see the range here is from 77 roughly down here to 66. So that's a $11 range for staples, and this is weekly. So we could see it continue to roll in this channel. More than likely, the way it's at, it rejected back off here with double topping formation, is coming back down. It's probably trying to find support around the 50% retracement area or 618 retracement area. So we may see a bit of a move to the upside, but I think it's really going to flatten out over the next 4, 5, 6 months. So be aware. Let's go to XLV, which is healthcare. Healthcare is bullish, bottoming, looks like. So pay attention. We may see some upward movement here. Got a lot of downside momentum, so we might get a bit of a bounce if the Fed's able to kind of stop the fear factor going forward. But I really do believe if the Fed turns on the printing presses and starts acting as a lender of last resort for the world, that you might see healthcare and technology and biotech enter a new kind of a reflation wave. So be aware, there are some great opportunities, particularly if you're following my MENT live trades and my TT scanner features, which are part of the expert growth membership. And let's come over here, SMH. Semiconductor index is bullish. Again, I just mentioned that. Good solid momentum. You can see we've got this momentum behind market right now, pushing price higher. You see the momentum for the downside came down and then waned, and we finally broke to the bullish side. Now we're building momentum back to the upside. Could be very, very interesting. OIH, which is oil services, is bullish and breaking downward. You can see we've been kind of flat. We were bullish for a while, then went bearish, flat, went into the sideways trending, then went bullish a bit for a while. Now we're coming down into this downward cycle trend. As soon as we're below this level, this stop level, we need to be very cautious. We're likely to change direction. XME is bullish as well, losing momentum. So we could see it move to the downside again, ladies and gentlemen. My prediction for oil is 62 for crude oil. I think we're going to see it move down into the 59 to 62 area before trying to find support. Let's take a look at XOP. Oil services is moving downward as well, breaking below this big channel. This is really an indication of stagflation. What happens in stagflation is that higher costs, higher credit costs, slowing economy moves people away from spending freely on oil and travel and all kinds of things. So understand that we are in a contractionary phase. It could be very strong if the Fed moves into some easing for technology, biotech, healthcare, maybe even defense, maybe even alternative energy. But again, we are in a general contraction phase, meaning that we are likely to see the market struggle over the next 4 to 6 months, which is why it's important to pay attention to the MENT rotational modeling system as a key to protect all of your assets. Now, the foreign markets have been doing really well, so I'm going to take a look here at Yang. So Yang has really been moving all over the place, 20, 30, 40%. Still bearish right now, building a solid bottom. We'll see how this rolls around. You can see we've had some huge moves. Now, this is weekly, so if I were to move to daily, we get a different picture. And with some of these foreign markets, you have to move down to daily and understand the volatility is quite extensive. Daily Yang is bullish. Daily MJ, the marijuana sector, is bearish. Now down at 3.64. Could bounce from these levels, but this is kind of a nowhere sector right now. Daily Nugget, which is the bull ETF, is bullish to the upside. Daily, let's take a look at SILJ, the silver junior miners, is bearish, about ready to turn bullish. So looking fairly positive. We've just got to break above this. Maybe next week we'll see it turn bullish. Let's take a look at UNG. Everybody wants to know about natural gas. Daily UNG is rolled bullish on March 6th, trying to find a base or a bottom. Very likely could find some sort of a base or a bottom here and try to move higher. The next move here is not likely to come until October, say, call it August, September, October. So be aware, the cyclical pattern in natural gas is that near the winter time, as demand starts to ramp up, that's when you start to see the biggest move. So you could be in a sideways downward trend here, doing nothing for the next 5-6 months. Let's take a look at SIL daily. We have bullish trend as of 3:15. We're breaking away from the bearish pricing pressure. These red areas likely to turn green as we start to move upward here. Let's go to gold. Obviously bullish. Look at this great move. Yep, been bullish. Look at this. Been bullish in gold since November 7th. Back over here at 156. Beautiful little uptrend. Stays with it. And again, the purpose behind these coloring is to show us where price is likely to stay, where the momentum is. So this showed us we had a lot of momentum building right here, and then it weakened. It just dissipated. And we had a little bit of momentum here, but it was waning. Then we flipped into this mode, and we had a lot of momentum to the upside, and look at what happened. Same thing here. A lot of momentum to the upside. Eventually, it waned back out right over here and stalled. That's where we want to kind of protect ourselves to make sure that we're trading effectively. Let's take a look at the Ultra Dow 30 DDM. Dow is bearish, moving downward here on a daily basis. Let's take a look at this on a weekly. Staying bearish. So you can see here, it's not really moved to the upside yet. We do have the momentum showing here. Bullish momentum, so we really need to get above this 70 level. Again, very similar type of pullback. If you can see it, here's the lows down here. Here's the highs up here. We're right now right in this 50% retracement area. This is a very solid bottoming, basing area if it holds. Obviously, we're still bearish, so we're not expecting any kind of a big move here, but I do expect, honestly, I expect the Fed to come in, kind of save our butts again from these crazy bankers. and move us back into some sort of a stagflation mode back into this area. Okay, kind of attempting to build some sort of a base and move higher. I do not believe we're going to see some sort of an extended downward trend. If we do, it's going to likely be a very quick base, and that'll be the end of it. Okay, again, everyone, as I have been promising you, I've been giving this stuff away for months to try to show you what I'm capable of and how I can help you. Now's the time to come in here and take advantage of my services. Sign up for the Expert Growth membership if you are an active, skilled trader and investor. Otherwise, message me and let me know at my website, MENT.com. Let me know that you're interested in an investor-only solution. If you are just interested in going over the basic markets and paying attention to the MENT rotational modeling system without having my custom indexes, which is this, then let me know. I might set something up very simply for people who have a retirement account, who have an investment account, maybe, set something up where it's very simple. You can follow my research. You can protect your capital. You can stay ahead of these big trends. It'll cover the general market trends like we've been doing back over here. So you can see what's going on in the general market sectors like this, and teach you how to allocate and move your capital away from risk effectively, and it basically provides you with a suitable solution for managing your IRA or 401k in an effective manner, an efficient manner to be able to grow your wealth over the next 10, 15, 20 years. Let me know. And again, if you want access to what I'm doing, my SPY cycle patterns and everything else, please come join the Expert Growth membership. It's right down here. You can get a 60-day trial. It's well worth it for $35. And again, this is the biggest opportunity of your lifetime over the next 10, 15 years. I'm going to promise you one thing. If you thought 2008 was crazy, 2008 and 9, just get ready. The next 10, 15 years are going to be full of some of the biggest market swings you've ever seen. So if you want to learn how to protect your capital from potentially 30, 40, 60% declines one way or the other, then come follow my research. Take advantage of the services that I'm providing to you and follow what I'm doing. It's really that simple. All right, guys, thanks a lot.